Hey, welcome to the podcast. Thanks for joining me. It's November 20th, and the stock market is closed. And this is a 1-minute picture of the S&P. Something happened today that you probably heard, and you probably can see when exactly that took place, which was right in here. So the Fed minutes came out, which of course are details of their just fascinating and interesting conversation about interest rates and the economy and whatnot. And they basically said tapering could be coming in the coming months. And, initially the way I look at this is tell me something we didn't know. We know they're going to taper at some point, right? We knew a few months ago when they looked like they were set up to do it and then they didn't, that it was put on the back burner. That didn't mean it never was going to happen, but it's put on the back burner. I'm not saying I know if it's going to come in December, January, February, March. I have no idea. There's certain signs that would lead me to believe that they're going to continue this forever, Q eternity, right? But there are some other signs that would point to the fact that they're at least going to begin slowing down the process. So you've got these Fed minutes that are old, right? This isn't something they said yesterday. So they've had a lot of data come out since the minutes came out. So keep that in mind. This is a very lagging indicator at best. But we also have Janet Yellen coming in, who is a big dove, right? She's going to keep doing this. So who wins? Well, at the end of the day, they've said it's going to be data dependent. We'll see. But I just didn't think anything in today's news was shocking. I mean, we knew when they said they weren't going to do it a couple of months ago that the consensus was sometime in December through March, right? Well, isn't that the definition of the coming months? So I don't think it's a huge shock. What this points out to me is that the market is once again going to throw a temper tantrum whenever QE is threatened to be taken away. And that's exactly what we're getting. And what's interesting is, in the last few days when QE looked like it was going to continue because of Janet Yellen, some of the comments she made, the stock market went up, but, it didn't go up as much as you would have thought, and it certainly didn't go up as much as it used to go up back in QE2 or QE1. So it's almost as if the positive effects of QE, at least psychologically, are fading, and the negatives, though, are still here. Anytime it's threatened to be taken away, the stock market throws a pity party, and down we go. So, and look, as far as what its real effect is, I think it's ineffective at this point. And you can argue for the last couple of years it's been ineffective. We were joking around in the office saying it would be funny if they just started slowing it down underneath the surface and didn't tell anybody they were doing it. And it probably wouldn't affect anything. But they're so trying to be so transparent, and they're so wishy-washy that the stock market and the bond market right now and the metals market and the currency markets are just all over the place because we don't know what's going to happen. And so it's very hard to invest money based on those types of comments. So that's why we frankly just don't do it, because you don't make moves based on what the Fed minutes say or didn't say. But there was no doubt that the stock market, which was a little higher today, when the minutes came out, they reversed and started heading down. Now, if you look at this, you go, well, the S&P was down 6.5 points. It's still at 1781. What's the big deal? And that's the point. It's really not a big deal. I would say overall the stock market has been stretched. We've got sentiment is very bullish, which is a contrarian indicator, meaning lots of people feel like it's going to continue to go up. And so, you're at that point right now where there is a lot of complacency. And we've talked about in the past podcasts that complacency is okay if you're in a strong bull market. So, complacency is okay. But in the short term, sometimes when you get too much complacency, obviously it pulls back a little bit. And we're stretched. So again, as we've been pointing out, we're in this pattern, right? And logically at some point, whether it's now or later, you would think we would come down a little bit. And perhaps we could come down a lot. But again, I still don't see a huge evidence of panic selling. If you look across the board today, it looked like a pretty bad day, didn't it? But if you go through what really worked today, you can go through all kinds of things. Biotech worked today, right? It was actually up about 1%. Healthcare stocks up about 0.3%. Pharmaceutical stocks up a little bit. Bank stocks were up a little bit, just fractionally, but they were up. Oil and gas exploration kind of held its own. And retail stocks, all those were in the green today. They all held their own, and they were in the green today. Meanwhile, the Dow Jones was down 66 points, or 0.4%. S&P down 1/3%. So it wasn't a horrible day. It was just that it went from really, okay day on the positive side to a negative day, and it was a good excuse to sell stocks. So we may still have some more downside, but let's take a look at interest rates, because that was the big mover of the day. Of course, when that news came out, you can see that, and this is a daily. We'll switch to the minute by minute. So it took a big spike when that came out, but it had been moving up already because there's some anticipation about that. Who knows? But again, we've talked about this, that if you have a lethargic economy and rising rates, that may be a really bad combination, because we've put up with a lethargic economy, at least in market has, because we've had QE, we've had stimulus. So if you take that stimulus away, and again, I'm not saying this is right or wrong. I'm pointing out that this is the thinking on Wall Street. But if you take that stimulus away, and you have interest rates going up, and at the same time you have the economy mediocre at best, that's not a good recipe for stocks. And we also don't see a lot of inflation, right? We saw the numbers come out today that show that we have deflation. So gold was already under pressure. And then, of course, we got the this tapering talk, and that pushed gold down even further. But here's interest rates. If we go back to the daily picture of rates, I told you earlier that I thought that this was setting up to move higher. We had the breakout. We pulled back a little bit. We tested the 100-day moving average, the 20-day moving average, the 50 days, all kind of right in here, and we bounced today. So this looks like it can go higher and perhaps test the old highs. Now, there are those that say, hey, this data is old from the Fed, and the economy has actually deteriorated. Some of the data has deteriorated since we've had that. And look, the Fed is always worried about deflation, because deflation is hard to control. So they need to err on the side of putting more money in there. Inflation is easier control because of the fact that it chokes itself off, right? If things are too expensive, you just stop buying them. Deflation is harder to control. So if we get CPI coming out today, which was weaker and weaker and weaker, and arguably some people are saying year over year it's the weakest it's been for 50 years. Well, if that's the case, are they going to taper really? So that's where the debate comes in, whether they're going to do it sooner or later. At the end of the day, though, they're going to do it at some point. And again, I wouldn't base all my decisions on what they're doing, but we need to be looking at how investors are reacting to this stuff. And right now, investors are, at least on the bond market, are believing them that they are going to do it. And that's why you're seeing rates go up. Despite weaker economic data, you're seeing rates moving up. So again, I talked about that in our income strategy. We have a short position, meaning we benefit from rising rates. We still have that position on. It was up about 3.5% today. So a good day over there. If you take a look at gold, which we have a small gold position as kind of a core piece that's been there for a long time, that's something that got hurt today. And that's in a different strategy, but that got hurt today simply because of the fact that, again, gold likes fear, which we haven't had a lot of fear lately. It likes inflation. We haven't had a lot of inflation. And it likes, if anything, it would like an accommodative Fed, and yet we've got a Fed that's threatening to be non-accommodative. Is it de-accommodative? They're not accommodative. And so you get gold down about 2% today. So a fall there. So now it looks like gold's setting up, and this is the GLD, that it theoretically could test this 115 level, which is only about probably 4% below where it is now. That's highly possible, but it is oversold to the downside, so we could see a bounce out of gold. And remember, all these inflationary assets are becoming cheaper and cheaper. Like if you look at TIPS, this is the ETF that tracks TIPS. Remember, these are bonds, a basket of bonds that are tied to inflation-protected securities, and people's expectations of inflation. This hasn't been doing well because it's typically tied to rates as well, and so you can see it had a big down in May when interest rates spiked up, and since that time, it's just kind of been in this box, and it's still in there. These assets are on sale. At some point, inflation will kick in. Some point. And when it does, all those different things like gold, like tips, are going to take off, and it's going to be hard to get into them. So, acquire a little bit of some of these things at times, again, on big sell-offs, because you're getting inflation assets cheaply. Just don't overdo it, because right now that's been the losing trade. So I have a piece of it in there, and it may lag, but again, there's going to be inflation at some point in the future. So keep an eye on that. Okay, we talked about Tesla last night on the blog. We wrote an article, a technical article, about just from a pure charting standpoint where this could go. And I think it could reach this 110 level, and you can go back and look at that at carleggers.com. Here's the 200-day moving average. There's a couple of things lining up there, and I won't go through all of it because it's already on the blog. But if you look, this was the leading stock on the negative side in the NASDAQ 100. So there's 100 stocks in these kind of big technology companies for the most part on the NASDAQ 100. There's other companies. There's gold companies and whatnot. But a lot of technology companies. Well, Tesla was down 4% today, or $5. So it looked like I had a nice day yesterday. It looked like it bounced, which it did. But keep in mind, when something bounces, don't think that's the end of the trend. You always want to look at also the intraday. And you see how intraday it was making lower highs, and it did that yesterday. So had it gone up above the prior day's highs, maybe you could say something's starting, but it didn't do that. And then today, again, it started up in the morning, but a lower high. And at the same time, we're making lower lows. So I think this thing could, yes, it's oversold. It could bounce, but I think ultimately it could go to 110. Now, there may be fundamental reasons why it should be at $60. Okay, this is still a very expensive stock, but what you're looking for in this particular situation is a company that was momentum. It's going through some issues with these fires, and what you're looking for is some type of event that will drive it down to where it's very scary to buy. That's when you're going to make your money with Tesla. That's an easy buy. I'm not saying it couldn't bounce tomorrow and that's the end of it. But if they get a fine, if they have a recall, if they have some event that drives this thing down, that's when you want to buy it, because they will survive all of this. They're obviously the Apple of the world in the car industry as far as the slick products and how they do things and how smart they are. They're going to make it to where when you hit a speed bump, the car doesn't blow up. they're gonna fix that little problem or big problem, but because it's a battery issue. But here's the thing: you want to see that whoosh down. You want to see the volume accelerate to where it feels as if the company's future is threatened and that they're going to go out of business. That's what would make me start to become interested in the stock. But also just on a technical level. Again, if it starts to form a floor right here around this 110 level, and we start to see some of our indicators turn back up, then it might be an interesting trade. I still am leery of it as an investment at this point, but because it's expensive, and when it's expensive like that, obviously one mistake and it gets hammered, right? You've seen it over the years with several companies that are going along nicely and they get hit hard. A company like Rackspace has been going through that for a while. Rackspace, and I'll zoom out here and pardon some of the lines, but let me take some of them off here. But let's take a look at Rackspace. Rackspace was a company, $4.50 based in San Antonio, big technology company, $4.50 in 2009, almost got to $100 earlier in the year. They started having these sell-offs, rally, sell-off, rally. So you got a nice little trend there saying, hey, I can make money with this. When it came down to here, we actually bought some, got stopped out of it because the trade did not work. It went down much, much further, went back up, and now it's failing again. Now, why did all of this happen? Why did the stock fall from good graces right in here? What happened? Well, the growth started slowing down. Is it 12 o'clock where the growth rate has peaked? We're growing at 40%, 50%, 60%, 55%, 50%, 45%. Do you understand that the rate of change is slowing down? Yes, it's still very fast growing, but is it starting to slow? That's what happened with this company, and it can happen with a lot of companies. And when that happens, things can change rather quickly. I mean, it went from $90 or so, and now it's sitting at 40. And Tesla may be going through the same thing. And so, again, it doesn't mean it's over, right? Look at Tesla. This is a picture here where, you can go back and, again, valuation aside, you go back and you say, well, this thing broke out here. How much of this up is it going to give back? Well, oftentimes it'll give back half of that. Well, that was $40 a share, and it got up to $200. So it should drop to about $120, $110 would be half of that. You can look at percentages. You can do Fibonacci, all these different techniques to figure out where is the logical place. I'm saying the first place is $110, but it certainly could come down to here, and if it's valuation, it could come down to here. I don't know exactly where it's going to be. That's the danger in these. It was down another 4% today. So if you're going to buy some and you love it, maybe you do start to scale in at this point, but just leave some powder dry and buy it in stages. Perhaps you say, I'm going to buy this 4 times, okay? I'm going to buy it. I obviously didn't want to buy it when it was $200 a share, but now that it's 121, we'll switch back to the daily view. I am going to take my first stab at it right here. And if it continues to fall, you set, and I'll buy a little bit more. Continues to fall a little bit more. The only time you wouldn't do this scenario is if you think they truly have some issues that are going out of business. But if you think that this is a great company, it's just the momentum traders are selling it to the downside and they're going to have to deal with some of these fire issues, then certainly, averaging down makes sense. Other people like averaging up. And I wouldn't say either way is exclusive. I say it depends on the company. When you have a company that's this popular and could do no wrong, just fall off the edge of a cliff, that's not the end of it. People don't just, there was times Apple fell previous to the big fall, right? And you could have made lots of money with Apple over the years. Same thing with Tesla right now. So I just point that out because it's a newsworthy stock. It's right in the middle of all the action and had a great day yesterday and then led to the downside today. So if you haven't seen it, go back, read the blog article at carleggers.com. You'll see it. And, if you want me to do some more of those charts, by the way, where we kind of annotate a lot of different technical indicators, feel free to send me some tickers and we'll do that. I'm not going to make a recommendation to buy it or sell it. I'm just going to tell you, here's some logical places. Here's some dangerous places. Here's some patterns that I'm seeing. I've seen a lot of charts over the years, and sometimes some of these patterns just kind of stick out like a sore thumb to where maybe they wouldn't to you, because maybe you just don't look at the charts that often. So if that's the case, send them to me, carl@eggerscapital.com, and I'll put them in a future podcast, or we'll just do a blog article about it. All right, guys, we still have a lot of data coming out over the next few days, and, it's a very mixed market right now. So be careful out there. Again, have some hedges. We talked about, real quick, just to mention that we still have our small cap short position on. As you can see here, it's kind of scraping perhaps the bottom. And again, all we're looking for is an overbought situation in the stock market to where the market goes down and our short position, and this is our aggressive strategy, kind of spikes up a little bit, and we take those profits, right? The market does this, and again, this is the short position, so it's opposite the market. Starts to roll back over. I don't even know what that is. Let me do that again. Kind of looks like something from asteroids. Remember that? But let's say this thing pops up and then starts to roll over. As it does that, the idea would be to lock this in and use those proceeds to buy something that has fallen that we really wanted to buy. Maybe a Tesla, right? Something like that. The point is that we're not banking at this point that the stock market is going to go down so much that this is going to go up to the moon. That's not the idea here. I still believe that the market is due for a rest, but we are still in a bull market, and it's simply based on supply and demand. Today was a perfect example. It may have looked really nasty out there, but it was not that bad of a day. And so what we're looking for, though, is the ebbs and flows. And just like when the stock market was going up and down, the short position is going up and down as well. And we feel like it may be ripe for some type of move higher here. And that's why, again, we wanted to keep a tight stop on this, and we will. But right here, you're kind of seeing this thing maybe coiling up for some type of little move higher. And if we get that, well, we probably won't get that. But if we get something where we have a nice profit in it and the market maybe corrects, let's say 5%, 7.5%, then we would take that position off. The other thing we would see is if we started to see the market deteriorate from an internal standpoint. In other words, if we started to see volume increase and more of a fear-based sell-off where there was real supply and demand issues going on, which we're not seeing now, but if we did, this is a position that we would add to. So we wouldn't just take profits up here. We may add to it if the market's deteriorating. But if it looks like just a run-of-the-mill correction, then we would take profits. So we still have our stop in place, but there's days where, it depending on which market's doing well and which market's doing poorly, you can have your short position on. And we shorted the Russell 2000. That's what this is. Russell actually outperformed today. That's another kind of clue that the sell-off today was in the Dow Jones, believe it or not. It was down 0.4%. If you look at the Dow, it was the worst of the big indices. The Russell 2000 itself was only down 0.14%. So it outperformed today, so it still shows you that there's some risk appetite. That's why today didn't give us any indication that this thing is, completely falling apart. This simply looks like we could start a little correction, but at the end of the day, it's just vibration. All right, have a wonderful evening, and we will talk to you soon.